Okay, so good afternoon or good morning, good evening, wherever you're watching this around the globe. My name's Adedamola Adetola. I'm responsible for the Bridgewise business in the Europe and Africa region based out of London. We're super excited to welcome you all to our first live webinar. We're going to be looking at unlocking ETF trends, and we're joined by Debbie Fuhr, who is the managing partner, managing director at ETFGI, which is a global research firm for ETFs. In her past role, she's led research teams for ETFs on a number of large financial services organizations. She's also the co-founder of Women in ETFs, and she's often known as the Queen of ETFs.
So it's a pleasure to be here, and a little background on ETFGI. So as Adi mentioned, I spent 11 years working at one of the large investment banks in London, started doing research on ETFs in 1997. At the time, there were 21 ETFs and $8 billion invested in them. I then moved over to BGI, which became BlackRock, was hired as an MD to create industry research for them. And then 12 years ago, set up my company, ETFGI. So we've been producing monthly research on trends in the global ETF industry for many years. We make a fact sheet for every ETF every month. And so today what I'm going to do is walk you through some of the trends that we see at the end of May. But first, I'll share just a little perspective. The mutual fund and ETF industries are still relatively young. Ironically, in March, the first mutual fund that was created, which still exists actually, turned 100 years old. So that was the Mass Investors Trust. It was launched, as I said, 100 years ago. If you look at ETFs, the first ETF was listed 34 years ago in Canada. It turned 34 on March 9th. And if you look at Europe, the ETF industry turned 24 years old. The US, although many people think it was first, is actually 3 years behind Canada. And I do think that is quite important. When we look at the ETF industry in general, what do we see at the end of May? So to set the scene, the ETF industry now has reached a record of almost 13 trillion US dollars. We look at the net inflows, so that is creations versus redemptions, and we're at a record level for the first 5 months of the year of nearly 600 billion US dollars. We have had 60 months of consecutive net inflows into the ETF industry. So that is 5 years. That's really amazing when you think about mutual funds or other types of products that investors use. They have had outflows many times over the past 5 years. So I think it's really impressive and talks to how all different types of investors are embracing ETFs. And because of the large toolbox and types of ETFs that are available, investors are able to find ways to use them regardless of what's happening in the market in terms of market moves, in terms of politics, economic news, etc. And I think that's quite telling. If we look at the prior history, 2023, we reached a record assets at the end of the year of $11.6 trillion. And if you look at mutual funds that year, they had net outflows of 651 billion, while the ETF industry recorded net inflows of 974 billion. The prior year, ETFs had net inflows of 856 billion. The mutual fund industry had outflows of 112 billion. And in 2021, we had net inflows, our record year for ETFs, of 1.3 trillion, while the mutual fund industry had outflows of $36 billion. So we have seen that trend, just to set some perspective for you there. Maybe just backing up a little, because if people are new to what is an ETF, what are mutual funds, I think it's probably important to kind of share some definitions. So stocks or shares, everyone knows IBM or Vodafone or Apple. Mutual funds, as I said, the first one was created 100 years ago. So what did it offer? The benefit of diversification. And it still is a very popular product, especially in defined contribution products. So think of 401k plans where the whole infrastructure has been created to allow people to invest in mutual funds. Because one thing you can easily do with mutual funds that has not been institutionally available with ETFs is buying a part of it. So you can buy 1/10 of a mutual fund, but like shares, when you buy an ETF, you have to buy a full share. Most of the mutual funds are actively managed, which has pros and cons there. They tend to have higher fees than ETFs, and they also tend to pay advisors to sell them, something ETFs do not do. So ETFs come on the scene, and what is the difference? ETFs are, in essence, a mutual fund with the added benefit of being listed and traded on an exchange, which means you can buy it anytime during the trading day. They also have the benefit of this unique creation redemption process. So for people who are retail or trading or investing in smaller sizes, this is not an important attribute really. But what it means is when there is a very large order, and large would be more than 20% of the average daily volume that trades in an ETF on a day, there are what's called authorized participants. So brokers who are able to go and buy the underlying basket of securities, they send that to the custodian and the ETF gets bigger. So unlike mutual funds where you're sending money to the mutual fund manager when you buy and sell, the ETF trades like a stock and you can buy and sell just like any other security, or really big orders are done through authorized participants. And what does that mean? So if you think about, if you wanted to go out and buy all of the stocks in the S&P 500 to get exposure, right now it would cost you about 105,000 US dollars. Instead, you can go out and buy one share of an ETF and it would cost you 545 US dollars. And you can buy that at the open, you can buy it at the close, you can put limit orders, stop orders. Most people wouldn't say buying at the open or close is the best way to trade, but you can use any trading instructions that you would use for and share for the ETF. So when we move to the next one, why have ETFs become so popular? Because really they're the only democratic investment product out there. So what does that really mean? It means that normally institutions, meaning pension funds, sovereign wealth funds, hedge funds, asset managers, have a large toolbox of different types of things they can use, and the fees are very low. Minimum investment size is very high typically. When you look at advisors or retail investors, typically they have a small toolbox. They tend to have higher fees and smaller minimum investment sizes. With ETFs, everyone pays the same annual cost. The minimum investment size is the same and the toolbox is the same. And that is one of the reasons that ETFs have really become an appealing product for all of these different types of investors. And I'll show you more of that later. But in essence, what we've seen over the years is that in the early days, it was more institutional. In Europe, it is still more institutional than retail. But clearly in the US and other markets, we see a real adoption already from retail. We do see retail growing in Europe and across the world, and also financial advisors. We also see portfolio managers, fund selectors using them. I think really what's gone on is for many people, they've looked at historically, I mentioned ETFs are mutual funds with added benefits. Historically, they have been mostly focused on index, but today they're also active. But what you have found as a normal trend is most investors will try to rationalize where can they generate alpha themselves, buying hedge funds, picking stocks or bonds, buying mutual funds, or even now ETFs. But where they can't, they often use index products as solutions to generate alpha through asset allocation. So you see that happening. So what ends up happening is, and this was kind of one of the stories of why index ETFs have become so popular, is the ability for active funds to consistently beat their benchmark is challenging. Typically 7 out of 10 active funds do not beat their benchmark. So what you find is if you look at this chart from Spiva, they put this out every 6 months, it's showing you towards the middle left, it says US. And that's saying that in the prior year, 60% of funds with the benchmark of the S&P 500 did not beat that benchmark. And on a 3-year basis, it was 80%. And on a 5-year basis, 79% did not beat the benchmark. So for many people, if you look and try and spend a lot of time finding active funds to beat a benchmark and you can't do it, many have found that using an ETF that might cost you less than 10 basis points, you get that exposure, you have your asset allocation right, and you can generate alpha through that. And as you look around the world, you can see that there are many markets where it is challenging to find active funds that are beating the benchmark in general. And then that consistency over time is the other challenge. SPIVA started recently to look at fixed income. So now we're looking at fixed income. So this is a new set of research that they started to put together in the past 3 months. And same analysis, how many fixed income funds with different benchmarks are delivering alpha in a 1-year period over the benchmark, 3 and 5 year. And you can see for many strategies, even in the fixed income market, it is difficult to find funds that deliver alpha. It doesn't say they're not existing, it just says it is challenging, which is why we have seen a significant growth in the use of ETFs and index products. Okay, so where are we with the global ETF industry? I mentioned we have seen significant growth, but to put it in perspective, you can see that many would call it kind of hockey shape stick of the shape of the growth in assets. We've also seen a significant growth in the number of products. And if we look at the end of May, there's now 12,321 products. Many of them are listed on multiple exchanges. And the reason for that is many ETFs, when you want to be able to sell them in other geographies, you are required to register for sale and also list them on the exchange. And that's how you end up with so many different listings. The assets, as I said, are at $12.89 trillion. There's 752 providers. They're listed on 80 exchanges in 63 countries. So it is a global phenomena. And you can see the compounded annual growth rate has been 16.5%. You see things called ETPs, and I'll come on to that in just a moment. If we look now at where are ETFs domiciled, we see that the US is the biggest market for the ETF industry. So though Canada was first, it's not surprising given the US is the biggest pool of assets overall. So it accounts for about 70% of all the assets in the ETF industry today. Europe is about 15%, Asia Pacific is 7%, Japan is 4%, and many of you might have heard that the Bank of Japan holds about 55% of all the assets of the ETFs listed in Japan right now. Canada is 3%, then you have Middle East and Latin America. Now, it doesn't mean that ETFs aren't being used in those geographies. What it does mean is the ETFs that are being used are actually ones that are being offered in Europe or the US, and they are using those products. And then if we look at types of exposure, so equity exposure accounts for about 73% of all the assets, fixed income is about 16%, active ETFs are about 7% now, a relatively, as I said, new phenomena. Commodities are 2%, and every other type of product is much smaller. And on the next slide, it's showing you what types of products are available. So market cap is the most typical type of benchmark. So think of FTSE 100 or S&P 500. But you also have smart beta type exposures. And what is that? That means it's factor investing. So those are factors where there's academic research that over the long run has demonstrated that investing in these factors will generally do better than a market cap exposure. And there's typically 6 that are identified. So it's really harvesting that risk premia through the exposure to these factors. And the factors would be small size, value, undervalue tends to do better over the long run, momentum, quality, volatility, and high yield. So think of dividend ETFs. That was probably the most important and appealing factor for many investors, although most wouldn't call it a smart beta, but it would be one of the factors. And if we carried on, you would see that there's also emerging markets, there's thematics, there's ESG. So there's many different types of ETFs. And you can see that some have been developing popularity among the investors as they raise awareness for this type of exposure. ETFs, as I said, are structured as funds. So think UCITS funds in Europe, think 40 Act funds in the US, with the added benefit of being listed and traded on exchange with a market maker, with authorized participants, and with that unique creation redemption process. The ETPs, and the reason it is important as investors, if you look to invest in them, they will often cause you to have different tax and regulatory implications. So if you buy something like a gold product, it's typically structured as a grantor trust in the US, you'll be taxed as if you own a collectible. Some of them are commodity pools, you'll get K1s. So it is important to know what it is you're buying. It's also true that some of these products, when they're structured as notes, you will have counterparty exposure to the issuer. And that might not be a bad thing, but if you have a limit on counterparty exposure, you should be aware of how to account for that. So what we do see is the majority of products, as I said, are structured as ETFs, regardless of the geography. About 98% of all the assets are ETFs, but there are other structures out there. When we go to the next slide, we're looking at the net flows for the month and year to date. So one of the things that is appealing about ETFs is they really are a very good barometer of investor sentiment. So here we're looking at global flows. So we're combining what's happened in all of those different geographies where ETFs are listed, all the different client sentiments of where they want to put money to work. If you look within Europe, you might see flows are different, US, Asia, Japan. So aggregating it together gives you a general view of what's happening globally. And the way we measure it is, again, creations versus redemptions. That's why we call it net flows. So the net flows for the month, you can see that the majority on the left side went into equities, then followed by fixed income. Active has become, as I said, quite popular. We've seen many new products coming to market. And on a year-to-date basis, you can again see that the majority of money is going into equity ETFs. And if you look here, I don't know if you can see my cursor, but you can see that there is a significant difference year-to-date for the flows this year compared to last year. Whereas fixed income ETFs are basically almost in line with the level for last year. And when we look at commodities, this year we've seen net outflows, the red, whereas at this point last year, we did see people putting money into commodities. So often people would say putting money into equities means it's a more risk-on environment. When people put money into commodities, especially gold, they see it as a safe haven. And then, as I mentioned, year to date right now, we're at a record level for this time of the year. I think we'll end the year actually at a record also. So on the next slide, looking at some of the different types of products that are available and where we see demand, I would say that the market cap or kind of the plain vanilla ETFs are very popular and maintain that popularity around the world. So if you think of a product like the S&P 500 to give you a sense of the popularity, currently there are 84 ETFs tracking S&P 500 benchmarks, and in total, they account for 1.8 trillion out of that nearly $13 trillion. So a lot of investors are investing in that type of product because they hear about it on the news, they read about it in their newspapers, and it is the benchmark that most investors would think about if they think about investing in the US market. And it's used, as you can see, around the world. So the way you look is number of products, the assets, the flows for the month, year to date. We always compare it to this point last year and all of last year. I mentioned what smart beta is. I think what you tend to see here is that the majority of the assets and also flows have been in products in the US. So that would be the largest, followed by, if you look down here, Asia Pacific has been using those types of products. When we think about thematics, those products were really popular during COVID. During COVID, a lot of people were sitting at home, looking at ideas. If you live in the US and watch TV, CNBC is like a marketing machine for ETFs. They talk about what's happening in countries or sectors or themes, and they'll show you names of products and tickers, which I really think help to elevate investors using ETFs. We found that during 2021, according to a study by Charles Schwab, the number of investors in the US market, 15% of them were new investors that year. And I attribute that to kind of a silver lining of COVID. And we've seen similar numbers and findings coming out from many geographies around the world. Now you find, though, that thematics tend to be more popular in Asia and also in Europe. Asians really like themes a lot. You find a lot of the launches have been happening out there around themes. And then another story that's regionally very different is ESG, or sustainable investing, or climate exposure. It's something that state by state is not really talked about as much any longer in the US. I do think there are still people using it, but in general, if you look at the flows last year, you can see that there were net outflows in the US of 5 billion, while we had net inflows of like 50 in Europe. So it's definitely more of a European phenomena for ESG exposure, partially because regulators are encouraging investors to use that. We have the sustainable development goals. We also have people thinking about the PAB, or Paris Aligned Benchmark. So it's an area where most investors want to think about ESG, whether it's best in class or exclusion. So you can see that Europe leads the way, again, followed by Asia. And then on the next slide, we're looking at leverage and inverse. It gets a lot of attention. Often the regulators are concerned about this. I would say if you look at leverage and inverse, the most important thing is to remember is that they rebalance mostly on a daily basis. There are some newer ones that rebalance on a different frequency. But what it means is if they rebalance every day, you don't get a S&P +2 or -2 exposure consistently. They rebalance, and then the next day you get that. So you have to look at these products on a daily basis in terms of how are they trading, how are they pricing. It is not designed to be a long-term investment product. You need to be monitoring your portfolio very closely. Currency hedging is something that has come and gone in terms of popularity, but I think the main one here that I wanted to pull out would be active ETFs. So why are they taking off, especially now in the US? There's a couple of reasons. In the US, ETFs as a structure is more tax efficient than mutual funds. And the reason for that is that in-kind creation redemption means that when money goes in and out, you're not generating capital gains the way you would with the typical mutual fund creation redemption process. So what you find is the ETFs are winning many investors over, where they want to be able to invest in an ETF wrapper. So you find in the US that retail investors and advisors who use ETFs say that 80% of them say it is their preferred wrapper. So they're speaking to the managers of mutual funds saying, why don't you make ETFs? And so what you've seen is there's been a trend recently where a number of large active asset managers have converted mutual funds into ETFs. So think Dimensional Fund Advisors, think Capital Group. There's others that are also doing it, but I think those are the biggest ones. And so what you find is that's driven net assets coming into the ETF industry. It's also bringing in new investors. So ETFs tend to be more cost efficient. I said more tax efficient. And the other benefit to the end investor, why they want it, is you can invest in smaller sizes. You can invest anytime during the trading day when you want to. Not that they're all trading often, but they want that flexibility, optionality to be able to get in when and how they want to. So you can see the significant growth that we're seeing in the US, and that most of the net new assets is actually coming from the US, 108 billion out of that total of 125. And then on the next page, we're looking at emerging market exposure. What I would say there is ETFs, the other benefit they offer you is you don't have to worry about foreign investor status, opening bank accounts in China, depending on the benchmark, Korea, or other emerging markets, which can take a lot of time, even for professional investors. With an emerging market ETF, it will be listed and traded on an exchange near you and in a currency that you want. So you should look at ETFs as also offering the ability to access markets that might otherwise be difficult or hard to attain access into. And then crypto, that's been an interesting story, especially in the US, where due to the legal battle that was fought against the SEC by Grayscale, the SEC really was pushed to allow Bitcoin products to come to market. So they allowed 11 firms to launch crypto products at the exact same time. And the reason they did that is in the past, when one company was first to launch a type of ETF, they really won the lion's share of the assets and trading volume. And that would carry on. I mean, you can even look at the first futures-based Bitcoin product where the assets and the trading volume in the first one from ProShares was over $1 billion very quickly. The three that came later have gathered much smaller assets and much smaller trading volumes. So what we saw was firms like BlackRock, Fidelity getting involved in this, Invesco, Grayscale converted their fund into an ETF, so that brought across assets. And we are seeing now that people are looking at this in a different way as we have much more conversation happening from firms that historically had been negative or at least skeptical on the investment case for Bitcoin, such as BlackRock, now getting behind this as an investment product and offering it up. So it'll be interesting to watch how that continues to proceed. We have had these products in Europe for over 5 years, so it is a case where Europe and Canada were much earlier than the US. And on the next slide, I have talked about how financial advisors and retail use ETFs, but I think what's really important to look at is institutional investors around the world have been using ETFs for many years, and they are a big investor for many different reasons. Some will use ETFs as a way to allow them to diversify their own holdings. So we've recently seen how the Public Investment Fund in Saudi Arabia actually seeded an ETF that launched in Hong Kong with $1 billion US. We've seen other cases where the Ministry of Finance in Colombia worked with an ETF issuer, Global X, and launched an ETF in Colombia recently. Previously in Brazil, they did one. So we have seen large organizations getting behind and using ETFs as an investment vehicle. Probably one of the first was the Hong Kong Tracker Fund. During the Asian crisis, the Hong Kong government had bought Asian or Hong Kong securities. They created the tracker fund after the market returned because they didn't want to just hold on to these securities. And that product still exists and is actively used in Hong Kong. This shows you the types of investors. So you can see it's large pension funds. And as I said, they're all over the world: United States, Canada, Finland, Chile, South Korea, US. So I should also add that in some of the Latin American countries, the pension regulators have encouraged the pension funds to use ETFs to invest in markets outside of their home country or home region, which is part of the reason that ETFs have become very attractive in markets like Mexico, Chile, Peru, Colombia. Brazil is also becoming a user of ETFs, as they weren't very significant previously. And on the next slide, in general, who's using ETFs? So every year we look at any institution that reports holding any security, how many hold an ETF. And so you can see on the top where it says global, we identified about 113,000 institutions. Of that total, about nearly 11,000 held at least one ETF. And in total, they hold about half of all the assets. So institutions are still significant users. Although you might say, how do you define institution? We use the US SEC definition, which means that an institution is any entity that manages over $100 million. And so for many, that would include a registered investment advisor. But at that size, the way they invest is much more institutional in terms of having usually a very well-established process, a due diligence process, a monitoring process, et cetera. So classifying them as institutions makes sense. So you can see that in the US, a large portion of institutions use ETFs. You can see in Canada, it's active. Europe, it's less active. In the Middle East and Africa, part of the reason being that the reporting requirements are different in different geographies. So you don't pick up everything that is actually happening out there, but it is a good proxy for getting a sense of who's using ETFs. What we have seen more recently in Europe is that retail investors are using ETFs and savings plans. Often they are execution-only platforms where people really need to be able to find information on ETFs or even shares or anything they want to own so that they can make their own decision. Some of the things that we've noticed is that I mentioned the first mover advantage. So if you look at ETFs, we have some really big ones. So in total right now, we have 823 ETFs that on their own individually have assets of 2 billion or more. And if you were to add those 823 ETFs together, they would have assets of or account for 84% of all the assets globally. So as I mentioned, that first mover advantage, bigger funds get bigger. You do tend to find that the small funds do struggle to gain interest, but that doesn't mean they're not liquid. So I think you have to look at what is the liquidity in the underlying basket when you look to trade. But if you're a retail investor, financial advisor, trading in smaller sizes, that would be the role of the market maker, so there should not be an issue. The other trend that we've seen is a real focus on fees. So this slide is a little confusing to read, but basically what you're seeing here is the bars going up is representing how much money or assets are invested in ETFs that have an annual cost of between 0 and 10 basis points, so that bottom line. And so what you can see is there's 754 ETFs. In total, there's $5.5 trillion in that bucket. And then NNA is the net new assets year to date and the net new assets in May. So what you can see is that many investors are putting money to work in products that have lower fees. And then the next bucket is 10 to 20 basis points. And again, you can see that a lot of money is going there, but it doesn't mean that money's not going to some of these higher cost products out to the far right. So active strategies would have a higher fee. You also find that indices that are more complicated will have higher fees. But you have found over the years that most ETF issuers have created what they would call their plain vanilla ETFs, and they tend to offer them with lower cost. So that would be another important trend. So I'm going to stop on this next slide, which is looking at selecting an ETF. So as you can see, there's a lot of ETFs out there. There's a lot of different benchmarks. I think the most important thing for you to think about is what exposure do you want? Do you want something that's active? Do you want something that is an index product? Which benchmark best represents that exposure for you? Then I think you want to look at the structure. Do you want something that is a note? Do you want an ETF? You should also think about domicile. So if you are a non-US person and you buy a US listed ETF, you're going to suffer 30% withholding whenever income is paid out. That's true for mutual funds or ETFs. And they have to pay out income at least once a year. You're also going to be exposed to US inheritance tax, which most people do not want. And I should caveat again, I'm not a tax advisor nor a lawyer, but you should get your own advice. But this is something that most people would discuss when they think about using ETFs from the US. You also want to look at in Europe, if your ETF is domiciled in Ireland versus Luxembourg. If the underlying securities are US equities, in Ireland, the withholding rate is 15%. In Luxembourg, it's 30%. So there are nuances as you start to look at using ETFs that you should understand as you make your first investments. And then you want to look at what's inside of it. So let's go back to the gold example. Do you want to hold something that has gold bars? Do you want to hold something that's using futures? Is it using front month or forward month futures? How is it rolling them? So what's inside can deliver very different returns, which is similar to what benchmark you choose. Because if it has different securities, you're going to end up with different returns. There's also benchmarks that will be market cap, equal weight, smart beta, et cetera. So understanding, is the portfolio fully replicating? Is it optimized? Is it holding ADRs or GDRs instead of the actual securities? All of this is very important. And as I mentioned, liquidity is really how liquid the underlying is, not what you see every day on exchange, especially in Europe, where most of the trading is being done through RFQ platforms, which are technically OTC, so you don't see a lot of on-exchange activity. Currency, we have ETFs listed in many different currencies here in Europe, so you want to look at which share class do you want to invest in, if that makes a difference to you. And then do you want to buy something in Europe where ETFs do not have to pay out? So you can buy accumulating share classes, or you can buy distributing. So I think the ETFs are a useful vehicle for many investors, but I do think you need to do your homework to make sure that you understand the products and what you're getting into. And with that, I think it's a good opportunity to turn over to Adi so he can talk about what Bridgewise is working on to help you understand ETFs and how to use them. Thank you for joining.